The holiday season is here, but for small business owners, the real crunch time is the fourth quarter financials. As the year comes to a close, businesses face critical financial tasks. It's a time to wrap up the books, prepare for tax season, and ensure that all financial records are accurate. The fourth quarter is more than just a countdown to the holidays. It's the final push to set your business up for success in the new year. In this video, we'll guide you through a year-end accounting checklist to make sure your small business is fully prepared. Why year-end financials matter? Year-end financials are essential for several reasons. First, tax compliance requires businesses to maintain correct records to avoid penalties or audits. Ensuring accuracy in your financial statements will make tax filing smoother and stress-free. Additionally, reviewing your financials offers insight for better decision-making. You can spot trends, set budgets, and make informed business moves based on actual data. Lastly, it's key for financial planning. Knowing your current financial position helps you manage cash flow and strategize for growth. Now that we understand the importance of year-end financials, let's explore the steps to make this process seamless. Step 1. Review and reconcile accounts. The first crucial step in closing your year-end financials is reviewing and reconciling accounts. This ensures your financial records match the actual transactions. Start by reconciling your bank accounts. Compare your bank statements with your accounting records and address any discrepancies, such as outstanding checks or bank fees. Next, review accounts receivable and payable, making sure all invoices are collected and bills are paid. Don't forget to reconcile credit card transactions as well, ensuring expenses recorded in your accounting software align with statements. By regularly reconciling throughout the year, this process becomes much smoother and less time-consuming at year-end. Step 2. Conduct a comprehensive financial review. Once your accounts are reconciled, it's time to dive into a comprehensive financial review. This involves analyzing key financial statements to understand the overall health of your business. Start with your profit and loss statement, income statement. Review income and expenses to assess your profitability. Look for areas where you can cut costs or increase revenue in the upcoming year. Next, examine your balance sheet to ensure that all assets, liabilities, and equity are accurately recorded. This helps you understand your financial position at year-end. Finally, analyze your cash flow statement to find patterns in how money is flowing in and out of your business. Ensure you have enough liquidity to meet your upcoming obligations and identify any potential cash flow issues for the future. Financial metrics such as your debt-to-equity ratio, gross profit margin, and working capital should also be assessed. A thorough review now will help you enter the new year with a clear financial roadmap. Step 3. Prepare for taxes. One of the most important aspects of your year-end financial checklist is preparing for taxes. Being proactive will help you avoid last-minute surprises and potential penalties. First, review tax deadlines and ensure they are marked on your calendar to avoid missing any crucial filings. Organize all necessary tax documents such as W-2s, 1099s, and receipts for deductible expenses, and make sure employee and contractor payments are properly reported. Next, use your financial statements to estimate your tax liability and consider making estimated payments if you expect a significant amount due. This will help reduce the impact of any large, unexpected tax bills. Additionally, small businesses can benefit from various tax deductions, such as those related to home office expenses, equipment purchases, or travel. Consult a tax professional if your business underwent significant changes, like expansion or changes in its legal structure, to ensure compliance with tax laws. This step is critical for reducing your tax liability and ensuring a smooth tax season. Step 4. Review and update inventory. For businesses that hold inventory, the year-end period is the perfect time to review and update inventory records. Start by conducting a physical inventory count to ensure that the actual stock on hand matches your recorded inventory levels. If there are any discrepancies, investigate and resolve them promptly. Once the physical count is complete, update your inventory valuation. This may involve writing off obsolete or damaged inventory to avoid overstating your assets. It's also a good idea to analyze your inventory turnover. By calculating your turnover ratio, you can assess how efficiently you are managing your stock. If you have slow-moving inventory, consider liquidating it to free up cash flow for the new year. By making sure your inventory records are accurate and up to date, you'll avoid carrying unnecessary costs into the next fiscal year. Step 5. Review and plan for employee compensation. As the year comes to a close, it's crucial to review payroll records for accuracy. Ensure that all bonuses, commissions, and benefits have been correctly accounted for. Evaluating your current employee benefits program is also essential, as competitive benefits can help with retention and talent acquisition. Based on your financial review, decide if you can afford to give raises or bonuses in the upcoming year. This not only boosts morale, but also fosters long-term loyalty. Investing in employee compensation can save you significant costs in recruitment and training over time, as it helps retain valuable team members. Step 6. Finish your budget for the new year. With the financial review complete, it's time to set your revenue and expense targets for the new year, using the previous year's performance as a guide. Identify any capital expenditures, such as equipment or software, and plan how these purchases will impact your cash flow. This is also a great time to create a cash flow forecast that projects your business's inflows and outflows, helping you manage liquidity throughout the year. A well-organized budget serves as the backbone of your business's financial health, ensuring that you stay on track and avoid unnecessary surprises as you navigate the new year. Step 7. Review legal and compliance issues. Year-end is an ideal time to review contracts, licenses, and compliance with employment laws. Ensure that all agreements, leases, and contracts are up to date and reflect your current business needs. It's also important to renew any expiring licenses or permits, ensuring that your business operates smoothly without legal issues. Regular legal reviews help avoid penalties and fines, providing peace of mind that your business is fully compliant as you head into the new year. Step 8. Organize and back up your records. Before closing the books, make sure all your financial records are well organized for easy access. This includes invoices, receipts, and bank statements. It's vital to regularly back up your data, both in cloud storage and on external drives, to prevent any data loss due to system failures or other issues. Also, consider safely disposing of outdated records. Shred physical documents and delete unnecessary digital files to protect sensitive information. Proper organization and backup procedures help safeguard your business's financial data for future reference. Step 9. Close the books. The final step is to officially close the books for the year. Ensure that all financial transactions are recorded and categorized correctly, and don't forget to post year-end adjusting entries such as depreciation or accruals. Once that's done, generate and review your final financial statements, including the profit and loss statement, balance sheet, and cash flow statement. Double-check for accuracy and completeness before closing the accounting period in your software. Tip: working with an accountant or bookkeeper during this step ensures everything is in order, allowing you to start the new year with a clean slate. Step 10. Plan ahead for the new year. With the year-end financials done, reflect on your business goals from the past year. Did you meet your targets? If not, analyze what went wrong and how you can improve in the new year. Use this reflection to set SMART goals: specific, measurable, achievable, relevant, time-bound, for the upcoming year. If this video helped you, make sure to like, share, and subscribe. Stay tuned for more financial tips to keep your business thriving.